This move shouldn't have been possible. Silver didn't just rally. It broke straight through decades of gravity, then snapped back in hours. On January 26th, the price didn't climb. It went vertical, exploding from the low 100s to roughly $117 an ounce before collapsing nearly $10 the same day. That's not normal volatility. That's a system under stress. Here's why this matters to you. Moves like this don't stay contained inside charts or trading desks. They leak into confidence, into pricing, into how safe people feel holding cash, savings, or anything tied to stability. The market briefly printed its largest single-day surge since 1985, with intraday gains north of 10%, while volume surged on both the way up and the way down. Indicators flashed extreme readings, with short-term momentum pushed to levels that rarely hold. But here's the part nobody is saying out loud. This wasn't a random spike, and it wasn't just greed. The price hit something hard, something old, and something structural. And once you see what that barrier really is, the entire move looks very different. What happened next only makes sense if you stop looking at this as a single wild day. The move didn't begin with chaos. Silver was stable overnight, hovering roughly between $108 and $111. Then volume exploded. Price didn't grind higher, it launched. Within hours, it tagged the 117 to 120 zone, a level silver has not meaningfully interacted with in modern trading, and just as quickly it reversed. That sequence matters. This wasn't slow accumulation, it wasn't careful positioning, it was a compressed release of pressure that had been building for months. Silver had already logged 9 consecutive months of gains, an anomaly by any historical measure. The rally was steep, increasingly vertical, and disconnected from normal support structures. By the time price accelerated, there were no traditional trend lines left to lean on. Now notice the pattern. Extreme upside velocity, heavy volume, immediate rejection. That's not how healthy breakouts behave. That's how markets behave when too many forces arrive at the same place at the same time. So here's the question that reframes everything. Was this move driven by strength or by exhaustion finally revealing itself? Here's the claim that changes how you read the chart. This wasn't just profit-taking. This was mechanical exhaustion colliding with leverage. Look at the detail that matters. As silver surged toward $117, short-term momentum indicators didn't just rise, they maxed out. On the 4-hour chart, the RSI pushed near 87. That's not a warning zone. That's an extreme zone where reversals historically become unavoidable, not because sentiment changes, but because the system runs out of fuel. Price had stretched too far, too fast, away from any meaningful average. Now pair that with what happened next. The sell-off wasn't quiet, it wasn't thin. Nearly $10 were erased from the highs on heavy volume. That tells you something important. Buyers didn't disappear. They were overwhelmed by forced selling, margin pressure, and automated exits. This is what happens when leveraged positions dominate price discovery. Gains amplify quickly, but so do liquidations. Notice what's missing here. There was no single headline that caused the drop, no announcement, no external shock. The reversal came from inside the market itself. That's critical. When a market reverses without news, it's reacting to structure, not sentiment. And that's where this story stops being about one metal and starts being about the system it trades inside. Now watch how fast this escalates. When price moves this vertically, normal analysis breaks. Trend lines don't form, support doesn't build, the market skips the steps that usually make rallies sustainable. That's why this move forced traders to zoom out, away from short-term charts and into history. On logarithmic scales, the silver price slammed into a long-term barrier that traces back decades, connecting the highs of the 1970s and the 2011 peak. The 117 to 120 range isn't random. It's a level the market remembers, even if most participants don't. This is where normalization quietly breaks. 9 straight months of gains had already stretched probabilities. A vertical extension from the 200-day average pushed price far outside statistical comfort. In past cycles, this is the zone where markets pause, reset, or punish late positioning. Not because the long-term story ends, but because momentum outruns structure. Here's why that matters. When extreme moves start to feel normal, risk gets mispriced, traders expect continuation where history suggests resistance. And when that expectation collides with reality, reversals become violent. This wasn't a failure, it was a reminder. And the next phase depends on how the market responds to being told, not yet. Here's where the contradiction becomes impossible to ignore. While price was screaming higher on the screen, the underlying market was quietly tightening the screws. This rally wasn't being driven by people lining up to exchange physical metal. It was being driven by paper leverage. Futures, options, ETFs, and short-term vehicles magnified every move. And when leverage leads, reversals don't fade, they snap. At the same time, silver was tagging the highs, margin requirements were being raised. That matters more than most people realize. Raising margins increases the cost of staying in a leveraged trade. It forces weaker positions out regardless of conviction. So while headlines and commentary were still celebrating the move, the structure underneath was already shifting against it. Now look at the behavior on both sides. Long positions rushed in late, chasing a vertical chart. Short positions, already deep underwater, were being squeezed into covering. That creates explosive upside, but it also builds the conditions for a vacuum once buying power is exhausted. And when that vacuum forms, price doesn't drift down, it drops. Here's the line that changes how you see this. The same leverage that pushed silver higher is what made the drop unavoidable. Strength and fragility were coming from the same place. And once that clicks, the volatility stops looking chaotic and starts looking engineered by structure. Then the pressure stacked. Not slowly, all at once. As silver pulled back from the highs, multiple forces hit simultaneously. Overextended longs were forced to reduce exposure. Margin-sensitive positions had to be trimmed. Algorithms flipped from momentum chasing to risk-off in minutes. What looked like a single pullback was actually several exits happening on top of each other. At the same time, the broader valuation picture didn't disappear. The move had just slammed into a zone tied to long-term monetary expansion, a level that historically forces markets to stop and reassess. That doesn't mean the trend is over. It means the system is asking for a reset. And resets are rarely gentle when leverage is involved. Now, at speed, this all unfolded within hours, not days. That's important. Fast moves don't allow psychology to adapt. They create confusion, then fear, then reaction. That's how volatility feeds itself. Price becomes the message, and the message spreads faster than explanation ever can. Here's where the story tightens. When multiple stress points activate at once, the market stops being about direction and starts being about control. And that leads to the only question that matters now. Now pull this out of the chart and into real life, because this is where it stops being abstract. If you're not trading silver, this still touches you. Moves like this bleed into currency confidence, into inflation expectations, into how secure people feel holding cash or promises tied to it. When an asset can surge double digits in hours and then erase it just as fast, it tells you stability is thinner than it looks. Prices don't need to stay high to send that message. They just need to behave this way once. Think about how this lands on ordinary people. Savings that feel safe 1 month suddenly feel exposed the next. Costs don't fall smoothly. They jump and hesitate. Planning becomes harder. And when volatility shows up in places that were supposed to be boring, people start looking for alternatives, not because they're ideological, but because they're practical. This is why these moves matter beyond traders. They quietly change behavior. They nudge people to hedge, to diversify, to question assumptions they didn't even realize they were making. And once that shift starts, it doesn't fully reverse. If this feels familiar, say so in the comments, because what comes next depends less on charts and more on how many people are starting to feel the same tension. Here's the unsettling part most coverage never reaches. This isn't about silver. It's about how systems behave when too much value is stacked on top of too little trust. Capital doesn't move evenly when that happens. It rushes, it compresses, it looks for exits and anchors at the same time. And when confidence wobbles at the top of the financial structure, pressure flows downward toward things that can't be diluted paused, or rewritten. Silver sits in a strange place inside that mechanism. It's small, thin, and structurally incapable of absorbing large flows smoothly. That's why price doesn't adjust gradually. It gaps, surges, and snaps back. Not because the asset is unstable, but because the system around it is oversized. Too much liquidity chasing too narrow a channel creates violence, not balance. Notice the incentive structure. Leverage rewards speed, algorithms reward momentum, institutions manage risk, not belief. None of these actors are trying to stabilize the market. They're responding to signals. And when those signals conflict, volatility becomes the output. This is why these moves feel smarter than panic and stranger than speculation. They're not emotional, they're mechanical. And once a system starts behaving this way, it doesn't need outrage to keep moving. It only needs imbalance. From here, the path splits and neither option is clean. One path is stabilization. Price continues to cool, maybe revisiting the $100 breakout zone, letting excess leverage drain out of the system. Volatility compresses. Momentum traders step back. The market builds structure, it skipped on the way up. That outcome would look boring on the surface, but it would actually strengthen the longer-term trend by turning former resistance into support. The other path is faster and far less orderly. If pressure elsewhere in the system rises again, capital doesn't wait for confirmation. It rushes back into the same narrow channels. That's how markets jump from consolidation straight into another vertical move. Not because conditions improved, but because alternatives worsened. In that scenario, the 120 level stops being a ceiling and starts acting like a launch point. Notice what makes this uncertain. Both paths are plausible, and neither depends on a single headline. They depend on momentum, liquidity, and confidence interacting in real time. The next move won't announce itself calmly. It will show up as acceleration. And by the time it's obvious which path we're on, the market will already be there. Here's the insight that ties all of this together. What you just watched wasn't a price event. It was a stress signal. The spike, the reversal, the violence of it, all of that revealed how little room there is between confidence and disorder when liquidity gets trapped in the wrong places. Silver didn't misbehave. It did exactly what a small, rigid market does when oversized forces collide inside it. Reframe the story this way. This wasn't about how high silver went. It was about what broke when it tried. The resistance wasn't just technical. It was structural, historical, and psychological all at once. And the fact that price remains elevated even after a brutal snapback tells you something important. Whatever pressure built this move didn't disappear. It paused. That's why this isn't over. Not this market, and not this cycle. The next chapter won't start with fireworks. It will start quietly while most people are looking elsewhere. And when it becomes obvious, it will already be late. If you want to stay ahead of that moment, follow for the next layer of this analysis, because the system is still adjusting and it hasn't finished showing its hand yet.